Wednesday, October 12th, 2022, Monaco 64, home of alternative economics and contrarian views. So the Bank of England Governor Andrew Bailey has given UK pensions 3 days to sort things out. That's according to his comments yesterday. You've got 3 days left. I'm not going to extend the QE of up to 65 billion. But maybe it's a little different, and we're going to look at that today. So, yes, Billy and I are back. And Billy's doing very well. We've been out already today. My wife and I arrived yesterday at home around 6 p.m. So everything went smoothly. We had a very good time in Madeira, but it's always nice to be home. And as you can hear, I'm still got a little bit of that cold, but it's improving. So back to the Bank of England. While I was in Madeira, as you probably noticed, I didn't do as many videos. I did 3 while I was there. I tried to switch off a little bit, which is, of course, always difficult. I did keep an eye on things. But one thing that I had on my mind was why the Bank of England wasn't doing as much QE as it had promised. I think on Monday they said they do up to 10 billion, and they only did like 800 million, and they hadn't really spent much of that 65 billion. And I thought to myself, maybe they know that the gilt market is a losing proposition, and they've got a lot of gilts in their balance sheet, and they don't want any more of it. And I actually think that's what it is, because why would you want to buy something that's going to fall out of bed? Of course, then I saw yesterday actually a few articles about that they hadn't been buying much. And according to Andrew Bailey, it's because he doesn't really want to do QE. And this is just a special one-off, and that monetary policy has to be restrictive. And it might be so, but and then things started getting really interesting yesterday. A lot of comments, especially late in the day, UK time. Andrew Bailey was in Washington, D.C. at the Institute of International Finance. And he basically said that the UK pensions had 3 days, because he wasn't going to continue this up to 65 billion QE past the deadline of the 14th of October. And prior to him speaking, a lot of people in the markets were saying the Bank of England needs to extend this. This is not going to help. They said they need to extend it up until at least the 31st of October, because then we'd see the government's new plan for medium-term debt reduction, or if they ever gonna reduce the debt, which is like they never do, right? So when he said that, it shocked the markets. I think even the U.S. stock market dropped, the pound dropped, gold came back down a little bit, and then this morning we get this. Bank of England signals to lenders it is prepared to prolong bond purchases. Officials have privately indicated flexible approach if market volatility flares up. So it looks like Andrew Bailey has told the world one thing, but he's told the bankers privately another thing. And I think this is the FT and these bankers, they're concerned about Andrew Bailey, because they wouldn't have come out and said this. So Andrew Bailey, I'm going to come to him in a second about his history, and you see why this guy is very dangerous, I think. And another reason why I'm very comfortable with having gold and silver outside the system. And I'm not giving financial advice here, but I do have investments in the system, in mining and everything, but it's not the bulk of my savings. I think having a little bit of gold and silver will go a long way to protecting you if everything hits the fan, because never since I started following financial markets in the late 80s have I seen conditions like this, policymakers that are clueless like Bailey, it's really really scary, I would say. It's really uncertain what's going to happen. So let's just quickly go through this. It says the Bank of England has signaled privately to bankers that it could extend its emergency bond buying program past this Friday's deadline. According to people briefed on the discussions, even as Governor Andrew Bailey warned pension funds that they have 3 days left before the support ends. So that phrase could be remembered for a very long time. You have 3 days left. The famous last words. Bailey's comments late on Tuesday came as pension funds raced to shore up their derivative strategies before Friday's cliff edge. The industry has said it needs more time to avoid a repeat of the forced selling that prompted the BOE to launch the emergency support scheme that was in late September. So the reason the pension system is so much under pressure is because of over a decade of QE and over a decade of zero interest rates. It's basically led the pension industry, final salary pension or defined benefit, to leverage themselves even more to get the returns. And they use this strategy called liability-driven investments, which is basically a lot of derivatives. And they use interest rate swaps. And when interest rates move up like they were doing in September, and they're very volatile, all these derivatives become even more volatile because they're leveraged. And then you have to pay margin, and the pension funds don't have the cash. They had to ask the corporations that were packaging their final salary pension with these pension managers. They had to ask them for more cash. So it was a disaster, and it's not over yet. And you can see here that Bailey has no backbone or credibility because he's saying one thing to the world: I'm going to be tough. You've got 3 days left. But behind the scenes, he's telling the banks, oh, don't worry, we'll sort you out. So which one is it? So you can see that the Bank of England is really between a rock and a hard place, I would say. But before we look at the markets, just wanted to read a little bit about Andrew Bailey to show you what kind of character he is. So it says here in his Wikipedia, in September 2019, allegations were made of Bailey falling asleep during a meeting between campaigners acting on behalf of the British Steel Pension Scheme and the FCA. Yeah, he was the head of the FCA, which is the equivalent of the SEC for a few years, and of him failing to take swift action to protect those affected by what would become one of the UK's biggest pension mis-selling scandals. A subsequent National Audit Office probe into the case concluded that members of the PSPS suffered significant financial losses because the FCA failed to take action on numerous reports of some FCA-authorized firms giving unsuitable transfer advice. This led to parliamentarians commenting that the FCA was asleep at the wheel. So he literally was asleep in the meeting, Bailey. So I would say this guy is incompetent. And yes, look out, I would say. Especially if you have a final salary pension or defined benefit pension in the UK. I'm not trying to give financial advice because I'm not a financial advisor, but I would be worried. So eventually, though, I think the government is going to bail your pensions out, and the people who are going to suffer are the general public. And the currency is going to become worth less and less, because to bail things like that out, you need to print more and more money. And I would say that interest rates are going north of double digits in the UK, because the average rate since the creation of the Bank of England is just below 5%, the average Bank of England rate. And right now we're still at just above 2. And you could argue, oh, if we go back up to about 5, it should be okay. But don't forget, we've been below 1 or even below 2 for almost 15 years. So we a lot of times we don't go back to the mean. We go above the mean, just like we've stayed below for too long artificially. And another thing he said, you go back here, in 2021, Bailey objected to the title of a report by the House of Lords Economic Affairs Committee, and it was entitled Quantitative Easing, a Dangerous Addiction, saying addiction is a word that has a very damaging and particular meaning to many people who are suffering. I think it is wrong to use that word loosely. and frankly, I think it was a very poor choice of language. But it's proving now the meltdown in the markets, the fact that he's had to brought in QE again, even though he hasn't done as much as he said. It is an addiction. And the fact that he's promised the bankers that he will be there even after the 14th of October shows that there is an addiction. So that's where we are. And I think it's going to affect the markets everywhere in the US, in Europe, all around the world. And just before we look at the markets, just wanted to show you this beauty here. Funding panic imminent. Fed quietly sends 3.1 billion to the Swiss National Bank via swap line. So there you go. Credit Suisse in trouble. Has the Fed promised Bailey to send a few billion as well? He was in Washington, D.C. Who knows? So with that, let's quickly look at where we are this morning. It's 8:21 a.m. London time. We've got spot gold at $16.70. That's up about $3.50. High's been 75. Low has been 61. Silver is up by 8 cents or 0.5% at 19.21. High's been 33 and the low 19. The Dow futures is up 0.5%, 140 points. Nasdaq is up 84 points or 3/4, and S&P is up 0.5% as well, 20 points. To the currencies, sterling has rebounded a little bit. I guess this FT article has kind of helped. I think if that hadn't come out, things would be a lot worse, but we'll have to keep an eye on it. Sterling is up 0.5% at 110.20. The euro is up 0.1% at 97.19. The dollar is up 0.15 versus the yen at 146.07. And the dollar is down 0.25% versus the Swiss franc, 99.50. Dollar is down slightly versus the yuan at 6.17. And I've noticed that the dollar has rallied quite a bit against the ruble. We're now almost at 65. We're at 64.20. Aussie dollar up 0.25 at 62.85. The dollar is down slightly versus the Canadian dollar, 137.80. And the Kiwi dollar is up 0.5% at 56.13. To the general commodities, we got WTI crude. That's at 88.20, unchanged. Brent crude is up slightly at 93.60. High-grade copper is down 0.5% at 3.43. U.S. nat gas is unchanged at 6.76. The European nat gas futures, the TTF, that's down 0.2% at 155. So let's quickly check the bond market, starting with the gilts. The 2-year gilt yield is up almost 9 basis points at 4.27. The 10-year is up 6, just below, at 4.50 actually. And the 30-year is up 10 at 4.91. So still selling in the gilt market. And I think Bailey also said recently that he expects gilt yields to continue rising. So there you go. Maybe that's why he's not buying it. They're racking up a lot of losses. They've got almost $1 trillion of gilts. And who's going to cover the losses? Well, the taxpayer, of course. So there you go. If you enjoyed this video, make sure you hit the like button. Make sure you share it far and wide. Think about subscribing to my channel as well if you haven't yet. And with that, I wish you all a great rest of the day. Take care. Bye.